Hello, everyone, and welcome to BFW 2401, week 4 bank performance. And this is part 2. This is only 13 slides, and it should be the shortest among the 4 parts I recorded today. Now, if you allow me to share, we are talking now about the financial ratios. We already finished the introduction and data. Now we are talking about the financial ratio analysis, and we are specifically talking about the financial ratios. Now, we have many different ratios. We have common size, what we call ratios, and we have profitability ratios, and we have what we call risk measures. Now, if you look, this is balance sheet items as percentage of total assets or income as a percentage of total revenues. For example, in the income statements, we are talking about, in the balance sheet, we are talking about the leverage ratio. The leverage ratio is you can take equity over total assets, or you can take liabilities over total assets. And this is actually all measures of leverage. Also, when we talk about the income common size, we can talk about the income item as percentage of total revenues, like when we talk about net income over revenues, which is the net margin, or we can talk about the gross margin, which is the gross profit over the net revenue. So all of this actually, either inside the income statement or the balance sheet, are we call common size ratios. Also, we can talk about from a different perspective, which is the profitability ratios. Now, profitability ratios is based on revenues and cost indicators. And we can also talk about the risk measures, like when we talk about the measures of liquidity or the measures or credit risk and all those type of risk measures, we can have different ratios for that. This is the main classification, but we can go a little bit now and talk about the benefits of financial ratios. Financial ratios is a very, very good tool, but the problem is they are not complete. And one of the most important thing we find in financial ratios is they reduce or they omit the size of the impact of the size. For example, if I take now the huge bank in the top 1,000, which is one of the biggest Chinese bank, and then I divide it by, I want to take the return on equity. So I will have that net income over the equity and find that percentage. I can take the return on assets, which is net income over total assets for that bank, and then go and take one of the smallest banks in Malaysia, for example, or in Indonesia, or in anywhere in the Middle East, and do the same thing according to the numbers, which is the total assets, or the return on, if you want to calculate the return on equity, so return on equity over the total assets of that small bank. You will find the ratio. For the big bank, you'll find the ratio. Now you are allowed to compare between them. Size is actually reduced or omitted in this ratio process. So ratios, this is one of the most important thing about ratios. Of course, they have other weaknesses, and we will talk about them. But it's not like when we look at the ratio, for example, if we calculate the return on equity for any bank here, and we calculate the return on equity of another bank, it's the end of the story. No, we still have to have some type of intelligent interpretation. Now, equity may be the most important, ratio, which is clear, but we can talk about the return on assets. We cannot even now, as of today, we cannot compare between banks and corporates, as you will see in your tutorial, because it's different measures. You find a different ROA for this one and different ROA for this one. So you have, for example, corporations and banks, you also use the same ratios, but you cannot compare. So you have always to have this intelligent interpretation of the ratios. Now, financial analysis ratios relies on intelligent interpretation based on comparison with, this is what we say, trends, targets, and peers, which means when I find the ratio now, if I'm calculating the return on equity for public bank, So I need to see what was the return of equity during the last 5 years, and whether maybe I am better than the rest of the banks in Malaysia, but that's it enough. I want to see how I was doing during the last 5 years. Am I going up or going down, specifically comparing to the last year? And then also comparing to my targets. Maybe I'm making profit, which is making return on equity is say 10%, but my target was 17%. And now I'm out of target. Still, I'm profitable. So you have to bring that when you take the ratio and start to get the interpretation. You need to see how did you do before? What was your target, whether you achieve it or no? And also you have to look at the peers. Okay, banks who are in, or the average banks in my size, are they achieving the same, less? Am I up above the average, below the average of the industry? So this is what we call comparing to the peers. So we have also problems with data. Even if we have this interpretation, we have problem with data. See, problem actually with data is if we have inaccurate data, we can give which means a false inputs. We can also have a false output. So we have always this creative accounting can distort measures, which means we have always this different and this new standards and accounting that can give different interpretation between 1 year and the other year. You can also, that doesn't mean you are cooking the books. You can cook the book and generate all those type of measures that makes you, give you very cosmetic look, but I mean in your financial statements, but actually sometimes you do it according to the allowed accounting policies. For example, if you use FIFO and incorporates FIFO and LIFO and the average of the inventory, this inventory policies, you can always manipulate the bottom line. So you have to look at this, and this is one of the problems with data. Accounting data does not always accurately reflect the true market values, and this is clear because we are only dealing with the historical value. And changing accounting standards, as I mentioned, make trend analysis difficult. You cannot compare. If you are using LIFO last year, now you are using FIFO, and you keep shifting between those, then there is always a problem. I'm talking about the inventory, for example, policies, but you can talk about anything else. Accounting people know what I mean by LIFO and FIFO, and I think you have taken it in the accounting unit number, which is the core unit. Look at this example. For example, in Australia, they use, in 2005, they introduced a new FIRS, and they reduce, in that FIRS, they reduce high parts of the equities. So if the equity is high, and you compare the return to equity last year, and you compare it after the change of the accounting policy, and the equity is now becoming smaller, the return to the equity will be higher, and therefore the ratio will be higher. And this, what we say, accounting policies can actually change the interpretation, especially when we are talking about trends. Now, we have also another problem with the ratio. We have the averaging. It can hide details. And one very obvious thing, which we don't look at, actually, we are not, when we make the analysis of ratio, we are not interested to look at the history. The history is gone. But we think that if we make the ratios, we did very well, that's fine. But we want to know for planning, and if I'm an investor, potential or current investor, I want to see what the bank is going to do in the future. I'm not really interested in its history. So the impression is that the time will reflect itself in the future, but actually this is not always true. So one of the problems with ratios is when we show the ratios, we think this is the position of the bank. It is the position of the bank or the corporation in this right moment, but it doesn't mean it will be in the future. And this right moment was reflected only the past performance. Ratios need to compartmentalize the financial analysis. What do you mean by compartmentalize? Compartmentalize means you go and study, for example, the common ratios, and you calculate the activity ratios. Activity ratios, for example, the turnover, asset turnover, which means sales over the total assets, and then you have any other turnovers, which is for the activity. You can calculate the ratios for the income, the net income margin, gross income margin, and other profitability ratios. You can even calculate some outside ratios like market ratio, which is the share price, the PE, and all of those actually are testing different areas. But if you, at the end of the day, you want to merge them all and get one ratio. So actually, when you are testing the turnover, if I have a huge sales to the total asset, that means I'm not very profitable. Somebody else may have little sales and more profitable than me. So because of this, division among because each group of ratios look to certain area in our performance, we cannot actually merge everything. So this is one of the things that we when we talk about the compartmentalization of the financial ratios. So it's important in this case to look at the linkages. Okay, omissions. Of course, financial ratios only work with the the figures that is in the income statement and the balance sheet. So our balance sheet is out of the picture. And also we have another omission, which is the qualitative, which I talked in part one. The reputation of the bank, the quality of the products, the moral of the staff, all those issues, the corporate governance, so many things are not reflected in financial ratios. So what? So the conclusion is the financial ratios is a good tool, but it's not enough. So we have to look at so many things before we come to a conclusion about the performance of the bank. Now, let me just show you this, the difficulties with financial ratios. I said we have problem with the data, and this is according to because the input can be wrong, either because we are cooking the numbers or because accounting policies allow us actually to manipulate the numbers. We have problem with ratios, which is the averaging. Look, for example, this one, for this bank or this firm or this example. If you have in year 1, 6, if you make a profit of 6 in the first year and drop to 4 in the second year, drop to 3 in the third year, if you can average now and you can say the average is actually my average profit during the last year, the last 3 years were 6 plus 4 plus 2 minus times 3, it's actually 4. But actually, when you look at it in a deeper way, you can say I have dropped for the last 2 years with around 50%. So there is a drop. Profit decreases by 50% every year. So 6% we drop to 4 and 4 drops to 2. This huge drop telling you when we tell me the average is 4, I know the average next year will be maybe 50% of that. Or so there is a huge drop and there is big problem in that. So this is when we talk about the averaging. They look backward, already talked about it. They categorize or they make compartmentalize. There is omission of the balance sheet and the qualitative of balance sheet and qualitative. So actually, when we talk about the key financial ratios, the key question is the bank achieving the long-term objective of maximizing the shareholders' value? The second question, if we break down this question, are we asking, are the returns to shareholders high? What about the risk? Is it low? How about the contribution of each business unit and the organization or the bank? And if profit is coming only, for example, from the trading, and we don't do well in the loan part or the banking book, or most of our money is coming from the trading book. This also give us some question, and we have to understand why this is going. Even when we do the products, even in the loan side, when we have the housing loans, we have the credit cards, we have the business loans. If all of our money coming from the housing loans and we are making actually losses in the business loans, then we have to bring some question. End of the day, we are making profit, but that is not actually enough to conclude. Therefore, we move to the effective analysis of bank performance. We have to look at the financial ratios, but also we have to look at other key indicators, including the off-balance sheet and the share market data and indicators of qualitative performance and indicators of business performance. So we have to look how each business is contributing, how is the all this qualitative, and how is the share market data of balance sheet and addition to our financial ratios. And this is a very interesting thing to see. So this is the questions, which is we need to maximize the shareholders' wealth, and we have to ask those questions. So we start with this process. We have to collect absolute data, calculate ratios, identify the meaning of the ratios, look at linkages, and then also we have to collect information about the share market data, credit rating, non-financial indicators, other measures of performance, and calculate the growth rates and market shares. So this is the effective analysis. So we have the financial ratios here, which is a very tiny part. We have the balance sheet, the off-balance sheet, and then we have market data, qualitative indicator of business unit performance. Now we will come to some type of conclusion. That conclusion, we are saying, okay, we are now making profit, and we are doing well in the qualitative. We are doing in the off-balance sheet well. Every business unit is indicating. Is that enough? No. We need to see, we need to start now and look how that is okay and good for this year. But are we improving or deteriorating over time? Which means our profit and our performance in all those parts is better than last year. And maybe you can take the 5 years back, or going down. That is one question. The other question is, this is actually what we want. This performance, current performance of this year, is it really what we want? Which means we have to compare it to our targets and see whether we are achieving the targets or no, which is as like a benchmark. And then at the end, we say, okay, we are improving maybe from last year, and we are, doing, the trend is okay, and we are achieving the targets, but maybe this is just a very good year for everyone. We want to look at the peers. We want to see how the industry did. Our performance, especially in the financial ratios, is better or less than the peers. Or maybe when we make our targets, we're very, very humble, and we lower it, while actually we should compete. If we are less than the average, then we should strive to go up. And all we have to look for linkages, because we can do, as I told you, we can do very, very well, and doing well if we compared to the trends, doing well with the comparing to the peers, and well according to the targets. But end of the day, are we doing all this? Are we making all these profits because we are compromising something like the risk? Is this CEO come, for example, this year and started to give all those bad loans? Is he going in a very, very unhedged trading? Is he taking a very risky business? Because he will make more profits, but he will actually, accumulate more risk, potential risk for the future. So we have to talk, look at those linkages. All in all, we have to consider this process when we do our performance. With this, I conclude this part. Thank you very much, and let me share and see you in the next part. Thank you.